Good afternoon and welcome to this webinar for Baillie Giffords China Growth Investment Trust. My name is Gavin Lumsden, I'm from Citywire and I'm going to be talking to co-manager Sophie Earnshaw about how the portfolio is run and the challenges and opportunities she and co-manager Linda Lin are seeing. This is a good time to get an update from Sophie. Interest rates have started to fall, which could reduce the macroeconomic pressures on global markets and benefit China. However, with the US election 2 months away, there's also a potential for a further ratcheting of tensions between the two superpowers. Good afternoon.
Good afternoon, hi.
Lovely to see you. So I'll start with my first question, if I may. Early this year, Baillie Gifford established a dedicated China equities investment team. So what are the resources available to the trust now?
Yeah, so the context here is that at BG we've been investing in China for 30 years now. So 2024 is actually our 30-year anniversary. And so the establishment of a dedicated China equities team was really the next step in what's been quite a long process of evolution. Our first investments in China in 1994 were via our emerging market products. We launched our first dedicated China product, the All China OIC, in 2006. And then in 2019, we launched our dedicated A-share product. In 2020, we won the BG China Growth Trust mandate. So we now have a very well-rounded suite of dedicated China products. 2019 was also the year that we opened Baillie Giffords' first investment office overseas, and that was in Shanghai. So prior to this, Baillie Gifford had conducted all of its research out of Edinburgh. We decided to change this model and set up directly in China because China was big enough and important enough to merit its own dedicated office. And we continue to believe that and have continued to add resources every year since opening the office to our Shanghai presence. So we've gone from 4 investment managers in Shanghai to 7. And this is in the context of most of our competitors pulling resources out of China, shutting offices, shutting down products. At the beginning of this year, as you said, we took the final step, which was to establish a dedicated China equities team. That team is split across Edinburgh and Shanghai. So we're a team of 10 now, 7 in Shanghai, 3 in Edinburgh. Linda Lin, a partner at the firm and a key driver of our investments in Chinese companies for Scottish Mortgage and for long-term global growth, has come back from Shanghai to head the new team and to join me as co-manager on the China Trust. Out with the dedicated China team at Baillie Gifford, we have around 50 or so analysts that cover China for their respective regional or global teams. And out with BG, we've spent the last 30 years or so building up our network of third-party and academic resources to supplement the work we do internally. And we continue to add resource here as well. So we've recently added a couple of domestic policy-oriented third parties, an additional due diligence provider, and we're also experimenting with how AI can supplement our research process.
Okay, so that's great. So a big team for a big market, but China has posted, unfortunately, 3 consecutive years of negative returns, as you know, but this year has brought some signs of stability. What developments are driving that?
So firstly, it's important to note that the 3 consecutive years of drawdowns that you refer to in Chinese equities, that was unprecedented. Now this year to date, we have seen some improvement with our index rising by around 12% in sterling to the end of July. There are a number of drivers behind this positive return. Firstly, incredibly low valuations at the beginning of the financial year. So the index was trading at around 9 times 2024 price earnings multiple. That's a multiple that was almost 1 standard deviation below its 5 and 10-year average, less than half that of US equities, and below that of both MSCI ACWI and emerging markets. So needless to say, after a 12% increase in our index, valuations are still very attractive as we sit here today. The second reason, there's been an increased focus on shareholder returns by large corporates. This came after the appointment in February of a new head of the China Securities Regulatory Commission. and after intervention in the market by Beijing via the purchase of stock index funds and SOE buybacks. And then the third factor was really incrementally supportive policy coming out of Beijing with regard to the economy. Now, as of today, it's really the economy that's holding back a more aggressive increase in equity valuations. Sentiment and consumer confidence continue to be quite weak, with the property market stabilizing but not significantly rebounding. And at this point, I think it's important to take a step back, actually, and just to put the weakness in the Chinese economy in context. So, we believe the economy isn't in crisis, it's in transition. And it's a transition that needs to happen to secure the country's long-term economic health. So the country is transitioning away from its old model of property-led growth to a new model of innovation-led growth. Now, there's clearly a risk that the government fails to manage this transition successfully. And it's fair to say that the transition of such a big economy won't happen in a straight line, but we do remain cautiously optimistic. And there are a couple of reasons as to why. The first is really that, China is, despite the very negative headlines, China is still growing at about 4.5%. For an $18 trillion economy, that's not bad. Second, whilst the property industry continues to be a challenge, we are seeing stabilization. And looking just at aggregate growth, we think is likely to miss an important point. And that point is that new growth drivers are filling the gap. So areas such as green technology, industrial upgrading, the digital economy. And finally, from a portfolio perspective, what we find on the ground is that China continues to be a place where growth companies are being created. And as we noted actually in our annual report, our portfolio holdings continue to grow despite the broader aggregate macroeconomic weakness. So in 2023, for example, our portfolio holdings still grew at around 17%, versus an index at 2%.
Okay, that is encouraging. I was just wondering about earlier this summer, the Communist Party, China's Communist Party, had its third plenum. Did we learn any more there about, what the decisions that were made that might affect the country's economy?
Yeah, so for context, the third plenum that took place in July, as you said, it's one of the most important meetings for long-term economic policies in China, and it only happens around every 5 years. Now, many were disappointed that the meeting didn't offer really any clue on how the government is going to further tackle the property downturn. But I think what it really did tell us is that Beijing believes the best way to get through China's current economic difficulties is not by a mass sort of very large rescue of the property industry, but instead by accelerating this structural transition away from it. So what we did find out was that they announced detailed policies to support innovative sectors or these new productive forces that are going to drive the economy over the next 10 years. So in areas such as AI, biotech, and renewable energies. What this means is that looking at aggregate economic metrics isn't really the central focus anymore. Instead, it seems as if the government is focused more on this transition away by supporting things like science, technology, and manufacturing. And when it comes to our portfolio, we believe that our portfolio is very well positioned to benefit from this structural shift, and also actually incredibly attractively valued. So a couple of examples here. In green technology, for example, we own a company called BYD. It's a leading EV manufacturer. BYD now sells more cars than Tesla. Its hybrid model can drive around 2,000 kilometers on a full battery and full tank, meaning its fuel efficiency is now world leading. And BYD is only trading on around a 14 times forward price earnings multiple versus Tesla at 60 times. Now, another example, China's not only a leader now in battery technology, but it's also a leader in solar. So one of our portfolio companies, Sungrow, it's a maker of solar inverters. This is a company that's selling globally, taking share, growing at 20% per annum, but again, only trading on a mid-teens earnings multiple. But we're also seeing growth within the portfolio in the more traditional or sort of consumption-related areas that we've historically been invested in. So, for example, Meituan Dianping, a leading online food delivery and services provider. So that they're delivering 90 million meals a day now at their peak versus, for example, DoorDash in the US are only 6 million a day. Meituan grew its earnings at 60% in the first half of this year. And again, it's now only trading on a 17 times earnings multiple. Or indeed, Proya. So Proya is another good example. It's a budget skincare company. So again, sort of consumption oriented. It's benefiting from two key things. One, Chinese consumers' preference shift away from mass market multinational brands to domestic brands. And two, from trading down in this weaker sort of consumption environment. So they grew their earnings at around 40% in the first half of this year. And again, only trading on around 20 times price earnings multiple.
That's also very interesting. Are there any more implications for China's technological development and priorities?
I think there are. And I think here, I mean, if we're talking about sort of technological development and priorities for China, I think we need to bring in geopolitics here. One question that we're often asked is around, US restrictions and whether or not these restrictions on technology access, whether this is restricting the opportunity set in China. And here, I'd really say, we think that geopolitics is likely to continue to create noise for Chinese companies. However, I wouldn't say it's restricting the growth opportunity set. I'd say it's changing it in two key areas. So first, there's a lot of talk about deglobalization. Instead, what we're finding on the ground is that Chinese companies, in some instances, are doubling down on going global, particularly going global in emerging markets and the global south. And the second key area is really on US export controls on, for example, semiconductors. Now that will continue to remain a challenge, but is this challenge actually accelerating China's pursuit of technological self-sufficiency? And technological self-sufficiency really featured very highly in the readout of the third plenum. So, on point one, on deglobalization, if you look at the data, the share of intra-EM trade with China is actually at an all-time high. So whilst the US and China are decoupling, we're not actually seeing evidence of deglobalization. Whilst trade barriers to richer Western markets aren't ideal for Chinese companies, it's worth noting now that EM already accounts for more than half of global GDP. And it's also worth noting that China has become, for example, the world's largest car exporter, BYD, a key element there, but that 75% of these exports are going to emerging markets. So listed Chinese companies now are selling more to emerging markets than to developed ones. And these emerging markets, we think, represent big growth opportunities for the next 2 decades and beyond. I'd also say that it's true that Western markets aren't completely closed off to all Chinese companies. So for example, e-commerce platform Temu, that is continuing to grow rapidly in the US and Europe. Another example in the portfolio, Anker, that's a consumer electronics company. It's Amazon's #1 3C brand. Or we have a company called PopMart, a toy designer. They plan to open 200 stores in the US. On point two, and on sort of technology and US export controls, We think it's clear that US export controls on semiconductors are accelerating China's desire to pursue technological self-sufficiency. And as I said, that was a key priority at the sort of the third plenum. So we already own companies such as SG Micro and Silogy in the analog semiconductor space. Now they're operating in segments where foreigners still dominate, but these foreigners are rapidly losing share to these domestic competitors. And the growth opportunity for these companies is, in the long run, it's a multiple. It's sort of 4 or 5 times. And then out with analog semiconductors, it's no secret that China has, for example, tried to build a domestic advanced semiconductor hub, really for the last 20 years with little real success. It's possible, perhaps, that export controls ironically accelerate domestic innovation and lead to growth opportunities that perhaps didn't exist previously.
Right. Well, and what about the US election I referred to in my introduction? What difference could all that make?
So I think it's unclear at the moment. What I would say is that there is bipartisan support for the tougher line that's been taken on China by the US over the last 5 years. So I think it's very likely that whoever wins, China will continue to be seen as a strategic competitor. But the devil's really in the detail. And the detail is always subject to change pre-election and post-election. What I would say is that Trump is generally thought by the market to be incrementally negative, given he's talked about continuing and indeed escalating the trade war with China via, for example, higher tariffs, whereas Harris's stance has been tempered to a certain degree by talk of greater cooperation with China in certain areas while de-risking and decoupling in others. Bringing it back to the portfolio and the trust, I would note that most of the companies within our portfolio, as I've alluded to earlier, are either exposed to domestic Chinese growth or largely growth excluding the US, with a particular focus on the global south and emerging markets.
Okay. You've highlighted both the high-tech and the kind of consumer areas that you're interested in. But what are the other themes that the Trust is exposed to?
Yeah, we're exposed to a broad range of growth themes within the Trust portfolio. As you said, some of these I've already talked about. So in addition to semiconductors, the green transition, we're also exposed to things like advanced manufacturing. This is a very broad area, but includes portfolio companies like Innovance, Megmeet, and Sanhua. So China already has the largest industrial robotics market in the world, yet robot density is only around a third of countries such as Korea. So there's huge upside there in terms of factory automation and robotics penetration. And this penetration is increasing and should continue to increase as wages continue to gradually rise. The other area that I would highlight would be the platform companies, companies such as ByteDance, Tencent, or Meituan. Most of these platform companies were negatively affected by the regulatory crackdown a few years ago. The regulatory environment is now much more stable for these companies, and support for these companies has been reiterated at the highest levels, meaning that really the biggest headwind to their future growth has become a tailwind. All of these platform companies are now growing strongly as the structural online trends that support their businesses continue to drive growth. Yet again, they remain very attractively valued. Another area would be more in the consumption polarization. So with the property market continuing to depress consumer confidence, we've seen a real bifurcation in demand. So I mentioned Proya Cosmetics, which is benefiting from trade down. We've got Guijiao Maotai, that's China's only really domestic luxury goods companies. So they They produce a high-end baijiu. They're still seeing very reasonable demand. We've also got companies like Luckin and PDD. Luckin is a relatively new holding. It's a sort of mass market value for money coffee shop. It's already grown to be 3 times the size of Starbucks in China. However, it's still got a very large growth opportunity ahead of it. So the Chinese only drink around, I think, 3 to 5 cups of coffee per year versus maybe 500 cups in the West. So really big growth opportunity for Luckin there.
That's very interesting. Thanks, Sophie. I'm just wondering, in light of the ongoing undervaluation or cheapness of many of these stocks, have you made any significant adjustments to the portfolio?
Yeah, so portfolio turnover in the most recent period picked up to around 29% as we decided to take advantage of some of the recent share price volatility to add to some of our highest conviction holdings, build positions in new ideas, and move on from companies where the investment case was challenged. Let me put that 29% portfolio turnover in context. This comes after a couple of years of single-digit turnover in the preceding years. So what have we been doing? Well, we've been adding to some of our highest conviction holdings. So one example here would be we've made significant additions to Tencent over the last 6 months. Tencent is now one of our largest overweight positions. Now, these additions to Tencent came after a number of meetings with the senior management team and significant internal work done on share price upside. So, the company has a varied collection of assets with, we think, very strong monetization potential ahead of them. So these assets include a very dominant social media and messaging platform, WeChat. That messaging platform is still incredibly dominant. It is the go-to platform in China. You really can't live your life without having that app on your phone. It has a leading gaming business with growth potential domestically, but also significantly overseas. And then more recently, they're seeing very significant success with their video platform, which is seeing them regain some of the share they'd lost in advertising. And then on top of that, a dominant payments business. So as I mentioned in the answer to the earlier question, the regulatory backdrop, with that improving in China and with the government reiterating its support for these innovative companies, we think that one of the biggest headwinds for Tencent has moderated. The shares have performed well this year, but we still think the company remains significantly undervalued. We're forecasting a combination of capital return via dividends and buybacks plus low double-digit earnings growth should result in really very attractive total returns for shareholders. We also added significantly to Meituan in February of this year. That came after a 60% reduction in the share price during 2023. We reassessed the company early in February. We're very pleased with the operational progress that the company had made. So the core business, that's food delivery and in-store hotel booking, that was trading on a multiple that implied very little growth, despite those core businesses delivering 20% revenue growth. There was concern around competition in the food delivery business, but we've seen Meituan retain its dominant position there and increase its profitability. So it hit its medium-term target of 1 RMB per order of profit. We did see margins in the in-store and hotel business halve due to competition, but then stabilize. And as a result of sort of better pricing, actually top-line growth accelerated substantially, more than compensating for that initial loss that came as a result of the margins falling. In addition, the management team have been much more focused on reducing losses in some of the areas that weren't delivering profitable growth. And as a result of that, we're seeing profits grow much faster than double-digit revenue growth. So the shares have done actually very well since February, and very recently we decided to take a little bit of profit from that position. Other changes that we've made, we bought some new purchases. So I talked about Luckin. We also bought a company called Shanxi Fenzhou. This is a regional Baijiu brand. In terms of funding at the margin, we've been reducing our exposure to e-commerce, given slowing industry level growth there and intense competition. So we moved on completely from JD.com and we reduced Alibaba. We also then sold a couple of our holdings in the pharma contract research and development space. So we sold out of companies Wuxi AppTech and Asim Chem Laboratories, where geopolitical issues were really starting to impact on their ability to win future contracts globally.
Okay, brilliant. Well, thanks. That's a comprehensive answer, and obviously quite a busy period for you. But clearly, there's some operational progress and good results coming through. Are all of these being reflected in share prices? You said some had seen some share price rallies earlier in the year and more recently. But broadly speaking, is the good progress in the portfolio being reflected in company share prices?
So we're starting to see some of our largest holdings' operational performance be reflected via better share price performance. But as I said, the Chinese market, it's stabilized this year. It's up around 12%. But we're still not seeing all of that good operational performance really be reflected. My contention is that for the Chinese market, actually underlying performance or earnings aren't the problem, but valuation swings can be. So, when you look at total earnings of listed Chinese companies, they've grown in line with GDP over the past 20 years, but earnings per share haven't. And that's as a result of a lot of share dilution in the past decade. Now, that's really the opposite of what we've seen in the US market, which is fond of buybacks. But we are seeing this dynamic beginning to shift. Lots of companies now buying back shares, thinking about total return. The second point is that the Chinese market is retail dominant, and sentiment can also cause extreme valuation swings. So if you look at, for example, the domestic A-share PE ratio, it's swung from 15 times to 70 times several times since 2008. But where are we now? Well, our market is currently trading at its lowest multiple almost in 20 years, at a near 60% discount to the US market, despite much higher expected earnings growth. So identifying a catalyst for this great operational performance to be reflected fully in better share price performance is hard. But I would say that starting point does matter for this asset class. And we are certainly at a very optimistic starting point today. Many good companies are valued at very appealing prices. So there is certainly scope for operational performance to drive share prices from here.
Yes, that an extreme disconnect should close at some point, you would hope. Okay, thank you, Sophie. Those are my questions, but let's turn to the audience. Does anybody believe that China is growing 4.5%? As statistics are all manipulated by the state, suggests one viewer.
Yeah, so we utilize a number of our third-party data providers to cross-check the data that comes out from the highest levels of government. And we're broadly seeing our third-party data match up with sort of what the government is saying, but there's a real sort of bifurcation. So, the property market continues to be relatively weak in the sense that it appears to be over the last couple of months stabilizing, but we haven't yet seen a sort of significant rebound. And what we are seeing is that is impacting consumption and consumption-led growth. But as I said in the earlier remarks, what we are seeing more positively, while property and consumption are weakening, we are seeing these new areas of growth really start to accelerate. So the hope would be over the next 5 years, really, that transition sort of sorts itself out, and that the fall or the stabilization in property is then more than mitigated by these new productive forces, which the government is really putting a lot of effort into supporting. And we do think that is the right sort of structural move to be making by the government for the long-term health of the Chinese economy. Although it's tempting to be sort of disappointed that the government isn't stimulating more aggressively, if you're going to take a long-term view on Chinese equities and the Chinese economy, you really do need to see this transition take place. So yeah, when it comes to data, 100% right to be skeptical of the data that comes out from the government. But as I said, we do try and supplement that with the third-party research providers that we use that, track things on the ground, across those 6,000 or so listed Chinese companies.
Yep. But the bottom-up view, as always, from a fund manager.
The bottom-up view, yeah.
Exactly. You and Baillie Gifford are well known for a focus on sort of looking for innovative companies. Well, there are innovators there, but there's also drinks companies, banks and insurance companies. So the question is, why not invest more in exciting mid-caps in tech areas?
Yeah. So Baillie Gifford is well known for looking for sort of innovative growth companies. But those innovative growth companies have to be attractively valued, and they have to be able to generate not just earnings growth, but share price performance. And sometimes that is the issue in China, where you will find a very, very innovative company, a company that is very well supported by the state, for example, and it is in a sort of strategically important area and innovating. But it is very, very highly valued. To the extent that, even putting in our most bullish assumptions for the company, we can't see it doubling in share price terms. So, a couple of areas, one would be, we talked about semiconductors, for example, and we are sort of broadening our research there. And we do think that there could be, ironically, the impact of export controls on China could be an acceleration in innovation, in particular in that sector. But what we are mindful of is valuation. So that's why we haven't, for example, invested in, a company like SMIC, for example, which is a foundry company in China, very well supported by the state, really trying to solve that issue for China of EUV, DUV, foundry semiconductor manufacturing capability, but is on a very, very, high valuation. Or for example, it's why we haven't decided to invest so far in some of the GPU or CPU companies in China, again, because the valuation is just too high, particularly given the context of, the run-up that we've seen in AI and sort of semiconductor stocks globally. So what we do have in the top 10, though, I think is a mix of innovative companies, but also good quality growth companies that can really deliver earnings growth over the next 5 to 10 years and are really not priced appropriately. So, that top 10 for me, I think is actually incredibly exciting. Companies like, for example, Tencent, they're well known, but they are remarkably undervalued. Meituan, another example. ByteDance, our largest unlisted holding.
Is it worth mentioning?
Trading on.
Go ahead. Kuaishou. Maybe you mentioned this earlier, but I don't know if I'm pronouncing it correctly. But Kuaishou, Mutai, fifth biggest holding. Am I saying it right? Because that looks like an old economy stock from which you're making very good, or it's making very good margins. Linda Lin has just recently posted an article all about it. I knew nothing about it before. Might be worth saying a few words about that company.
Yeah, so Guizhou Maotai, very good pronunciation. It's a baijiu maker, so they make a white spirit. It's a little bit similar to whiskey, so it's around 50% proof. You typically drink this at dinners or at times of celebration. We like this company because its brand is really unparalleled in China. the company itself has a rich, almost 500-year history. It's also very closely associated with things like the Long March and the CCP. So it's a really foundational kind of brand in China, and the result of that is that its pricing power is absolutely phenomenal. It is really China's only luxury goods company. Its pricing power is fantastic, and therefore the returns that it's able to make, the cash flow that it's able to generate is really phenomenal. And this is a state-owned enterprise. So again, I think it's really important in China not to overgeneralize. You characterize it as an old economy stock, but I really don't think it is that. It's more of a luxury goods company that's really, it's got a brand that would rival sort of Hermes in a Chinese context.
Okay, no, that does sound really, really interesting, and a good article to read on the website if anyone's interested to learn more. You mentioned ByteDance. Your largest unlisted holding, I think perhaps your only unlisted holding, but a couple of questions there. It's 8% of assets, and there's been constant news flow around the fate of its US business, TikTok.
Yeah. So, ByteDance. As you said, our largest unlisted holding, our only unlisted holding. So, a phenomenal business. Growing at a double-digit rate. So in 2023, it was growing its top line at over 40%, its bottom line at over 90%. It's a platform company, so it generates fantastic returns and great cash flow. Its advertising revenue is continuing to grow via monetization of things like Douyin in China, but also TikTok globally. E-commerce monetization is taking off. It looks to be taking share. It's one of the reasons why the competitive landscape in e-commerce continues to be very sort of fraught. Longer term, and one of the things that isn't widely recognized about ByteDance and some of these other platform companies is their capability in AI. So ByteDance is largely recognized as being one of the best AI companies in China with some of the best talent. It's an emerging leader in large language models. I think this could be pretty transformational, actually, for the business, the current business, and indeed for opening up new business opportunities for the company. And again, going back to valuation, a phenomenal company in terms of returns, growth, trading on a single-digit price earnings multiple. So remarkably good value. Obviously, as you alluded to, the stock has geopolitical risk attached to it, particularly via TikTok in the US. But our valuation work on the company has long excluded TikTok and the US business because of this well understood and well publicized risk of forced divestiture.
Yeah, absolutely. Thank you. It could be that that TikTok is, ByteDance is doing very well outside of the US. So, couple more questions. Yes, returning to geopolitics. Actually, there haven't been that many questions about geopolitics so far, but got a question here wondering, won't Beijing's continued saber-rattling versus Taiwan keep Western governments wary of China's ambitions? And won't that keep investors away from the country stock market, and despite the valuations you're talking about?
Yeah, I think that is right for some investors. So particularly those based in the US, particularly those investors that are more sort of public facing. But I guess what we've seen, it was interesting sort of in the last 6 months, really up until May, when the market was doing a lot better. We saw investors begin to come back, even in that short period. It then since dissipated as the economy and economic data continued to be relatively weak. But I think there will be investors willing to come back to China because of it is too big to ignore. It is the world's second largest stock market, it is a risk both to invest in China, but also to stay away completely. And I think that's the conversation that we are at least having with a lot of our clients. There's an increased acknowledgement that actually ignoring China completely and not having anything there is also a significant risk if your job is to generate attractive returns for your client base. There are also other pots of money, outside of the US. So, whether that's other global emerging markets that are, rapidly becoming very large economies and having a lot of money to invest themselves, or potentially the Middle East. So I think there will be a change in the investor, and there has already been a big change in the investor base in Chinese equities. We have already seen a lot of that US money leave the market. And I think it's right to assume that it won't come back, but I think there will be other sources of capital that will come in once China sort of gets back on its feet in terms of its economy, and as valuations continue to be so attractive and operational sort of fundamental growth continues to come through.
Right. Okay. Lovely. Kind of going back to where we started talking around resources and the team. But when did you last visit China? What sectors, companies excited you most? Well, you've talked a bit about that perhaps, but did you buy any new holdings after the last trip?
Oh, the last trip was, I think, in April this year. The trips that we do in China tend to be, they're either very broad, so where we're trying to meet, a wide range of sort of our existing holdings, new ideas. In addition to listed companies, we'll be meeting unlisted companies. We'll be trying to meet customers, suppliers, regulators, in some cases government officials. We'll really be trying to get a sort of well-rounded view of what's going on in the country, sort of on the ground, and really leveraging the local networks that our team in Shanghai have been able to build up. Or the trips will be quite specific and focus on, a specific area. My last trip to China was much more general. It was more of a touching base with a lot of the companies that we already own. And, really trying to understand some of these trends that are going on the ground, whether it's in consumption, that bifurcation trend that I was talking about, or whether it's in, for example, in semiconductors or in high-end tech. The companies that we ended up buying, Luckin, that came about after Linda's trip to China in January. So earlier in the year, she went on a trip with one of our emerging market investors, and they spent quite a lot of time with Luckin. So that new holding came out of that trip. And then Shanxi Fenzhou, the research for that was done by our Shanghai team. So that was really the catalyst for that company being a new holding. I'll be going out to China again probably in November. And I think Linda will also be there in the next couple of months. Linda's just back actually from spending 3 months in China over the summer. Okay, right. Well, it's good to know that you're both regular visitors to the country, and of course you've got boots on the ground with a team that's already there. Sophie, thanks very much for your time and your insights and giving us a good answers to the questions. There's clearly an awful lot going on in China. So do look out for more programmes to come. But in the meantime, from Baillie Gifford and Citywire and all of us here in the studio, thank you very much.